The most dangerous mistake a retiree can make with a new IRS notice is assuming that every official-looking request for bank information is real. That belief used to feel reasonable. A letter arrived in an envelope. It carried a government seal. It mentioned your tax return, your social security number, or a refund you were expecting. You followed the instructions because ignoring the IRS felt more dangerous than responding. But that simple habit has become a financial risk. In 2026, criminals are copying real IRS notices, using artificial intelligence to imitate government voices, placing fake QR codes inside professional-looking letters, and creating websites that can look almost identical to an official government page. One wrong scan, one rushed phone call, or one bank account number entered on the wrong screen can expose far more than a tax refund. It can expose the checking account where your Social Security arrives, the savings account holding your emergency money, and the personal information needed to enter the rest of your financial life. Pay close attention to this. There is a real IRS notice called CP53E that many taxpayers may receive when the IRS cannot complete a direct deposit of a tax refund or does not have usable bank information. The real notice can give a taxpayer a limited period to add or update direct deposit information through an official IRS online account. That sounds simple, but this is exactly where the danger begins. Criminals know that millions of Americans have heard that federal payments are moving away from paper checks. They know that taxpayers are confused about direct deposit rules. They know retirees may be waiting for a refund, may have recently changed banks, or may be uncertain whether the routing number used on a return was correct. The scammer does not need to invent a completely false story. He only needs to copy a real change, add urgency, and place a false doorway in front of you. The doorway may be a text saying your IRS refund has been approved, but cannot be released. It may be an email saying your bank rejected the deposit. It may be a letter claiming that you have 30 days to verify your account or permanently lose the money. It may include your name, your address, and even the final digits of information taken from a data breach. Then it gives you a link, a QR code, or a phone number. The message may say that failure to respond could create a tax hold, a penalty, or a review of your benefits. It may claim that the IRS has already tried to contact you. The design looks official. The language sounds serious. The amount may be believable, perhaps 1,842, 3,116 or 5,904. That precision is intentional. A strange amount feels more like a government calculation than a round number invented by a thief. Most people think the danger is losing the refund shown in the message. That is not the largest danger. The larger danger is giving a criminal the information needed to take money that is already yours. A fake refund page may ask for your full name, birth date, social security number, address, filing status, bank name, routing number, account number, driver's license, and a verification code sent to your phone. In less than 5 minutes, the criminal may collect enough information to attempt tax identity theft, bank account takeover, credit applications, social security impersonation, and Medicare fraud. The fake refund is only the bait. Your identity is the real target. Here is what almost nobody understands. A government scam no longer has to begin with a wild threat. The most effective scams begin with something partly true. It is true that the IRS sends notices. It is true that refunds can be delayed. It is true that a bank can reject a direct deposit. It is true that some taxpayers need to verify their identity. It is true that tax rules changed. It is true that certain seniors may qualify for a new deduction. The criminal places one false instruction inside several true statements. That is why intelligent, careful, financially experienced people are losing money. They are not believing a completely ridiculous story. They are reacting to a real situation through a fraudulent channel. I have watched the American financial system become more connected, more automated, and much faster. The IRS receives information from employers, retirement plan administrators, financial institutions, brokers, the Social Security Administration, and other reporting sources. Banks use automated systems to review logins, transfers, device changes, debit card activity, and unusual movement of funds. Credit bureaus collect account history from lenders. Medicare and Social Security maintain separate records tied to personal identity. None of these systems is the same system, but your name, Social Security number, address, telephone number, email address, and bank information connect your financial life together. That connection creates convenience, but it also creates a chain reaction when information is stolen. A criminal who gets only your debit card number may have limited access. A criminal who gets your social security number, tax filing information, bank account details, and one-time verification code may be able to impersonate you in several places. He may not take money immediately. He may wait. He may test the information on one account, apply for credit somewhere else, or attempt to file a fraudulent tax return before you file your own. The silence after a scam is sometimes what makes it most dangerous. People assume they escaped because no money disappeared that afternoon. Then a tax return is rejected months later, a credit account appears, or a bank login is changed overnight. This is happening quietly. The IRS identified impersonation by email and text as one of the major tax scam threats for 2026. These messages may use alarming language, fake refund offers, attachments, and QR codes that lead to fraudulent websites. The IRS also warned about artificial intelligence-enabled phone impersonation, including computer-generated voices and caller ID manipulation. A number appearing on your screen can be altered. A voice can be manufactured. A caller may know enough personal information to sound legitimate. The presence of your name, your age, your bank, or the amount of your last Social Security deposit does not prove that the caller is real. The old rule was that scammers sounded unprofessional. They made spelling mistakes, used strange grammar, or demanded payment with gift cards. Those scams still exist, but the new generation is more patient. The caller may speak calmly. He may tell you not to panic. He may claim that he is protecting you from another scam. He may transfer you to a fake bank security department, a fake IRS resolution specialist, or a fake federal investigator. Each person uses a different voice. Each person confirms the same case number. This creates the feeling that several departments are independently verifying the story. In reality, you are moving through different rooms of the same criminal operation. Think about how powerful that is against a retired couple. The first caller says the IRS detected a refund being sent to an unauthorized bank. The second caller says the couple's identity may have been used in a money laundering investigation. The third caller says their bank account must be moved to a protected government account while the investigation is completed. The couple is told not to discuss the case because it is confidential. They are told that involving family members could interfere with the investigation. The scammers stay on the telephone while the couple drives to the bank. They coach them on what to tell the teller. They may even instruct them to say the money is for home repairs, a vehicle, or a family matter. The phrase protected government account sounds official, but it is a lie. There is no legitimate IRS procedure that requires you to move retirement savings into a secret account for protection. There is no legitimate government investigation that requires you to purchase gold bars, use a Bitcoin ATM, buy gift cards, or hand cash to a courier. There is no IRS employee who needs your online banking password or the verification code sent by your bank. When someone says your money must be moved to keep it safe, the movement itself is usually the theft. This is why the new IRS notice issue matters far beyond taxes. The criminal uses the authority of the IRS to reach the bank account. The bank account becomes the bridge to everything else. Your Social Security payment may enter that account each month. Your pension may enter the same account. Your mortgage, insurance, Medicare premium, utilities, and credit card payments may leave it automatically. A fraudulent transfer does not only reduce a balance, it can cause legitimate payments to fail. Then, late fees begin. Automatic payments are returned. Credit cards become past due. Insurance coverage can be threatened. A single scam can create secondary damage across an entire household. Imagine a 71-year-old widow in Ohio. She receives $2,180 a month from Social Security and a small pension of $740. She keeps $28,000 in savings because she is afraid of unexpected medical bills and home repairs. A text arrives saying a $2,136 federal refund is pending. She recently filed a return, so the message does not seem random. She clicks the link. The page asks her to verify her identity and bank information. She enters it. Then a person calls, claiming that unusual activity was detected while processing her refund. He says her checking account may have been compromised and asks for a code sent to her phone. She reads the code. That code was not sent by the IRS. It was sent by her bank because the criminal was attempting to enter her account. Within minutes, a new external transfer account may be added. A small transfer of $27 may be sent first. The criminal watches to see whether the bank blocks it or whether the customer notices. If the small amount succeeds, larger attempts may follow. This is how modern financial theft can work. It does not always begin with $10,000 disappearing at once. It may begin with a test, a new payee, a changed telephone number, or a transfer scheduled for the next business day. Banks do monitor patterns, but bank monitoring is not a personal bodyguard. People often believe that a bank must automatically stop any transaction that looks unusual. That is not how protection works in every case. A bank may flag a transfer, send an alert, delay a transaction, or ask questions. But if the real customer appears to authorize the payment after being manipulated by a scammer, recovering the money can become much more difficult. The bank sees a customer who logged in, received a code, and approved a transaction. The customer sees a thief who controlled the entire situation through fear. Those two views can collide after the money is gone. This is not automatic. A bank is not required to know that the person on your telephone is lying to you. An employee may ask why you are withdrawing $40,000. A teller may warn you about fraud, but scammers prepare victims for those questions. They say the bank employee may be involved in the crime. They say the teller is not cleared to know about the investigation. They say the withdrawal must be described as a personal purchase. By the time the victim reaches the bank, the criminal has already weakened trust in the very person who might stop the loss. There is another reason retirees are attractive targets. A younger worker who loses money may have decades of employment ahead. An older person may have a fixed income and limited ability to rebuild. Criminals understand this. They also understand that retirees may have accumulated home equity, retirement accounts, certificates of deposit, treasury securities, pensions, or cash savings. The amount does not have to be enormous. To a criminal, a household with $18,000 in savings is still a valuable target. To the household, that $18,000 may represent a roof, a furnace, dental care, property taxes, and years of security. The Federal Trade Commission has reported a dramatic increase in large losses among older adults targeted by government and business impersonators. Reports from people age 60 and older who lost $10,000 or more rose more than fourfold from 2020. Reported losses above $100,000 increased sharply as well. These are not only careless people sending a few $100s to an obvious stranger. Some victims are transferring retirement assets, liquidating investments, withdrawing cash, purchasing cryptocurrency, or delivering gold because a sophisticated criminal operation convinced them that their life savings were already in danger. The psychological mechanism is simple but powerful. First, create a false emergency. Second, isolate the victim. Third, create an authority figure. Fourth, provide one urgent action that promises safety. Fifth, keep the victim moving so there is no time to speak with family, the bank, an accountant, or law enforcement. The scam succeeds when fear becomes faster than verification. The real IRS operates differently. The IRS normally begins contact through mail delivered by the United States Postal Service. There are situations in which the IRS may call, and taxpayers can choose certain electronic communications. But an unexpected call, text, email, or social media message demanding immediate personal information or immediate payment should be treated as dangerous. A social media direct message is not how the IRS resolves your tax account. The IRS does not call and demand a prepaid card. It does not threaten immediate arrest because you refuse to pay during the call. It does not require payment to an individual, a private business, or an account with a mysterious name. It does not deny you the opportunity to question or appeal an amount before using legitimate collection procedures. A real IRS notice also has a purpose that can be independently verified. This is where people make a critical mistake. They use the contact information printed in the suspicious message to verify the suspicious message. That is like asking a stranger to prove his identity by calling the telephone number he gave you. Of course, the person answering will confirm the story. The safe method is to leave the communication completely. Do not use its link. Do not scan its QR code. Do not call its telephone number. Open your browser separately and type the official government address yourself, or use a trusted number obtained from an official statement, previous verified correspondence, or the government website. For a CP53E notice, the key point is extremely important. The legitimate process directs the taxpayer to use the official IRS online account to add or update direct deposit information. The IRS will not ask you to provide that banking information through an unexpected email, text message, or telephone call. A criminal may copy the words CP53E because the code can be found publicly. Knowing the notice number does not prove legitimacy. The question is not whether the notice uses the correct name. The question is whether the action is being completed inside the real IRS system. Watch how this works. A retiree receives a letter that looks like a CP53E notice. The letter contains a QR code and says the refund will be canceled in 48 hours. The retiree scans it. The website address includes words like IRS, refund, federal, secure, or treasury. The page displays an American flag and a government seal. It asks the retiree to sign in. The retiree uses an email address and password that he also uses on another account. Now the criminal may have both his tax information and a password that works elsewhere. Then the page asks for bank details. Finally, it sends him to the real IRS website so that everything appears normal. By the time he realizes the first page was false, the data has already been transmitted. This is why you should never judge a website by its colors, logo, or professional appearance. A real government website can be copied visually in minutes. The address matters. How you reach the address matters. The security of the device matters. And even a lock symbol in the browser does not prove that a site belongs to the government. It only indicates that the connection to that particular site is encrypted. A criminal website can also use encryption. The CP53E notice deserves attention because the time period can create real pressure. A taxpayer may generally have 30 days to add or update bank information or choose an available exception. If the taxpayer takes no action, the refund may eventually be handled through a paper check under the applicable procedure. But a scammer can shorten 30 days into 30 hours. He can say this is the final warning. He can say a second notice will not be issued. He can turn an administrative matter into a financial emergency. A real notice should not be ignored, but it should not be obeyed blindly. Those are two different ideas. Verification is not the same as inaction. When you receive any IRS letter, compare it with the notice information on the official IRS website. Sign into your official online account without using the link or QR code in the letter. Review your account balance, notices, tax records, and refund information. If something does not match, contact the IRS through a verified channel. If you use a tax professional, send the professional a copy through a secure method and ask what the notice means before providing sensitive information. People sometimes feel embarrassed about slowing down. They think a legitimate agency will become angry if they hang up or refuse to provide information immediately. A legitimate agency expects taxpayers to protect their identity. A legitimate bank expects customers to question unusual requests. A legitimate financial professional will not object when you independently verify credentials. Only a scammer needs to prevent verification. If someone says, "Do not hang up," hang up. If someone says, "You must act before you speak with your daughter," speak with your daughter. If someone says, "The bank cannot be trusted," call the bank using the number printed on your card. If someone says, "This payment must happen before the courthouse closes," stop. Urgency is information. Secrecy is information. Isolation is information. A strange payment method is information. When several of these signals appear together, the safest decision is not to negotiate with the caller. It is to end the contact. There is a second scam now spreading around a real tax benefit for seniors. Under current federal rules, eligible individuals age 65 or older may qualify for an additional deduction of up to $6,000 for tax years 2025 through 2028. If both spouses qualify and file jointly, the combined amount may be up to $12,000. The deduction is subject to income limits and begins to phase out when modified adjusted gross income exceeds certain thresholds. This is real. But the deduction does not require a special enrollment, advance registration, or an application fee. Nobody is going to tell you about this in the way scammers claim. The IRS is not sending private agents to enroll seniors by telephone. There is no legitimate company that must activate the deduction inside your Social Security account. There is no processing payment required before you can claim it. You claim an eligible deduction through the tax filing process. You do not unlock it by giving a stranger your Medicare number, bank information, or verification code. The criminal version may say that every senior is entitled to a $6,000 payment. That is false. A deduction is not the same as a check. A deduction can reduce taxable income. Its actual value depends on the taxpayer's situation, including income, filing status, and other tax factors. If a person in the 12% federal tax bracket receives the full benefit of a $6,000 deduction, the simple federal income tax effect might be around $720, not a $6,000 deposit. The exact outcome can differ. This distinction matters because scammers deliberately replace the word deduction with refund, benefit, stimulus, grant, or payment. A retiree hears $6,000 senior benefit and imagines $6,000 arriving in the bank. The scammer then says a $199 processing fee is required. The victim thinks, why would I risk losing $6,000 over $199? That is how a false comparison pushes the payment. After the first fee, another may appear. There may be a verification fee, insurance fee, tax clearance fee, transfer fee, or state filing fee. Each payment is explained as the final step. There is always one more step because no real benefit is coming. This helps both lower-income retirees and comfortable middle-class retirees understand the same danger. A lower-income retiree may be attracted by the promise of an immediate payment. A comfortable middle-class retiree may be attracted by the promise of lowering taxes or protecting assets. The language changes, but the mechanism is identical. The criminal creates a valuable opportunity, says you may lose it, and demands information or money before you have time to verify. Most people think they do not qualify for legitimate tax benefits, and that uncertainty makes them vulnerable to fake experts. A person may say, I am not wealthy enough to need an accountant, but my finances are too complicated to understand alone. That middle area is where dishonest preparers and scam operators work. They use tax vocabulary that sounds advanced. They mention forms, phase-outs, credits, adjusted gross income, or special elections. The victim assumes the speaker must be qualified because the language is unfamiliar. But complicated language is not proof of competence. A legitimate preparer should be able to explain the rule in plain English. He should explain why you qualify, what documents support the claim, where the amount appears on the return, what fee he charges, and what risks exist. A preparer who promises a guaranteed refund before reviewing your records is not demonstrating expertise. He is demonstrating a sales strategy. If this information is helping you protect your money, leave a like so more retirees and families can see it before an official-looking message reaches them. Now consider the refund scam from the criminal's point of view. Tax season provides several pieces of believable information. Millions of people file returns. Many expect refunds. Refunds can be delayed. Banks can reject deposits. Taxpayers may need identity verification. Criminals send enormous numbers of messages and do not need to know who is actually expecting money. They only need a small percentage of recipients to be in the right situation at the right moment. A message may say, your 2025 federal refund has been approved. Another says, your refund was returned by your financial institution. Another says, your identity verification is incomplete. Each message contains a link. The link may ask for the Social Security number and bank account. The FTC has specifically warned that the real IRS and state tax offices do not contact people by unexpected text, email, or social media to collect this information for a refund. A message claiming that your refund has been processed is not how you should determine refund status. The correct response is not to click and investigate. Even clicking can expose the device to tracking or malicious software. The safer response is to open the official refund tool separately. Enter through a trusted government website and check there. If the message is fraudulent, report it and delete it. Do not answer with the word stop. Do not insult the sender. Do not tell them that you know it is a scam. A response confirms that your telephone number is active and monitored by a real person. The money at risk may be larger than the expected refund because stolen tax information can be reused. A criminal may file a return using your Social Security number before you file. You may discover the theft only when your legitimate electronic return is rejected because the system says a return has already been submitted. The criminal may direct the fraudulent refund to a temporary account, prepaid card, or controlled bank account. By the time the taxpayer receives a notice, the money may already have moved through several channels. An identity protection PIN can reduce this risk. The IP PIN is a 6-digit number known to the taxpayer and the IRS. It helps prevent someone else from filing a federal tax return using the taxpayer's Social Security number or individual taxpayer identification number. A new IP PIN is generated for each calendar year. This is not automatic for every taxpayer. You have to claim it through the official process. Most people think they do not qualify because they have never been confirmed as identity theft victims, but eligible taxpayers can voluntarily request this protection through official IRS channels. The IP PIN is not a password to be given to a caller. It is not used to release a refund over the telephone. It should be protected like a sensitive tax credential. A dishonest tax preparer who legitimately prepares your return may need it to file, but an unexpected caller does not. A fake IRS representative may say, "Read me the 6-digit number so I can cancel the fraudulent return." That request defeats the entire purpose of the protection. If you already have an IP PIN, remember that the number changes. The number used in a previous year may not be valid for a return filed in the current calendar year. People sometimes store an old number with tax documents and assume it remains permanent. Then the legitimate return is rejected or delayed. That administrative confusion creates another opening for scammers who offer to fix the problem for a fee. When tax identity theft is suspected, the response must be organized. Secure the IRS account, secure the email account connected to it, change reused passwords. Contact the bank, review credit reports, consider a credit freeze with the major credit bureaus, preserve copies of suspicious messages and transactions. Follow official identity theft procedures, which may include Form 14039 when appropriate. But do not file forms randomly because a caller told you to. Some IRS identity verification letters have their own procedures, and unnecessary forms can create more confusion. A credit freeze is often misunderstood. It does not erase debt, repair a score, or stop transactions inside an existing bank account. It generally restricts access to your credit file, making it harder for a criminal to open certain new credit accounts in your name. A fraud alert and a credit freeze are not the same tool. Freezing credit also does not prevent tax identity theft by itself. That is why protection must be layered. The IRS account, bank account, email account, telephone number, and credit file each require attention. Most people protect the bank password, but ignore the email password. That is a serious mistake. Email is often the recovery doorway for financial accounts. If a criminal controls your email, he may reset passwords, hide security notices, and study old messages to learn where you bank, where you invest, and who prepares your taxes. He may create email rules that automatically move bank alerts into the trash. You continue using the inbox and never see the warnings. The same is true of the telephone number. Criminals may attempt to take control of a mobile number through a SIM swap or account takeover at the telephone provider. If successful, one-time security codes may go to the criminal's device. This is why a telephone account PIN, strong account credentials, and alerts for changes can be valuable. The financial system increasingly uses the phone as proof of identity. Protecting the phone account is part of protecting the money. This changes everything because the scam is not one message. It is an attack on the connections between systems. The fake IRS notice collects information. The stolen email password opens recovery links. The telephone number receives codes. The bank account sends funds. The credit file allows new borrowing. The social security number ties the identity together. Each piece may look small alone. Together they form a working copy of your financial identity. Now let us examine the bank side, because this is where victims often experience the greatest shock. A person may believe that money stolen by fraud will always be returned. That belief comes from experiences with stolen credit card numbers. A fraudulent credit card purchase and a customer-authorized wire transfer are not the same situation. Different payment systems, facts, laws, account agreements, and investigation results can produce different outcomes. A scammer may manipulate you into authorizing a wire, bank transfer, peer-to-peer payment, cash withdrawal, or cryptocurrency purchase. The transaction is fraudulent in the ordinary meaning of the word because you were deceived, but the payment system may record that you personally approved it. This distinction can make recovery difficult. That is why prevention is more powerful than reimbursement. Imagine a retired veteran in Arizona with $96,000 in a savings account and $240,000 in a traditional IRA. He receives a call that appears to come from his bank. The caller says someone attempted to move $1,400 from his account after using his Social Security number. The caller transfers him to a supposed federal investigator who says the account is connected to a tax identity theft case. The veteran is instructed to move $75,000 to a secure holding account. He is told the funds will be returned within 48 hours. The bank teller asks why he is wiring the money. The caller has already instructed him to say that he is purchasing property. The veteran repeats the story. The wire is sent. The receiving account is controlled by criminals or by a person recruited to move money. The funds are transferred again, converted, withdrawn, or sent abroad. 48 hours later, the telephone numbers stop working. The veteran did not ignore bank security. He followed what he believed was bank security. That is the cruelty of the scam. The protective instinct becomes the tool of theft. The person is not greedy. He is afraid. He is not trying to get rich. He is trying to prevent the loss of money he already earned. The FTC has warned that government and business impersonators often tell older adults that someone is using their accounts, that their identity is connected to a crime, or that their computer has a security problem. Those stories appear different, but they lead to the same instruction: move money to protect it. The moment a stranger tells you to transfer money for safety, stop. Money does not become safer because it enters an account controlled by the person who called you. Government agencies will not instruct you to deposit cash into a Bitcoin ATM. They will not send a courier to collect currency or gold. They will not tell you to purchase gift cards and read the numbers. They will not tell you to hide a withdrawal from your bank. These are not unusual government procedures. They are signatures of theft. Artificial intelligence makes the family emergency version even more dangerous. A criminal may copy a short recording of a relative's voice from social media, a video, a voicemail greeting, or another source. Then the criminal creates a call that sounds like a son, daughter, or grandchild. The voice says there was an accident, an arrest, or a medical emergency. A second person enters the call pretending to be an attorney, officer, or hospital employee. The family member's voice creates emotion. The authority figure creates instructions. The defense is a family verification system that exists before the emergency. A private word can help. Calling the relative back on a known number can help. Contacting another family member can help. But the most important protection is permission to pause. Families should agree that no one will be offended when an urgent request is verified. A real loved one in trouble would rather wait 5 minutes than see a parent lose $30,000. The same principle applies to IRS notices. Verification should be expected, not treated as disrespect. The system is complex enough that honest errors happen. A real notice may be issued automatically. A real payment may be delayed. A real account may contain outdated information. But the solution to complexity is independent confirmation, not blind trust. Now tell me in the comments, have you ever received an IRS, bank, Social Security, or Medicare message that looked real but made you suspicious? Or is this the first time you are seeing how these scams connect? There is another trap involving cash reporting rules. Many Americans have heard that banks report cash transactions over $10,000. Some believe any deposit above that amount is illegal. It is not. A legitimate cash deposit over $10,000 is not automatically wrongdoing. Financial institutions generally have reporting requirements for certain currency transactions above $10,000. The danger begins when someone deliberately breaks a larger cash transaction into smaller amounts for the purpose of evading reporting. That can be treated as structuring. Scammers use public confusion about this rule in two opposite ways. One scammer tells a victim to withdraw $9,500 from one branch and $9,500 from another so the government will not notice. Another tells the victim that a normal deposit triggered a criminal tax investigation and money must be moved immediately. Both stories misuse a real rule. If a person sells a vehicle for $18,000 in cash and deposits the money honestly, the size of the deposit does not by itself make the transaction illegal. The bank may ask questions or complete required reporting. That is different from intentionally dividing cash into smaller transactions to avoid a report. Never allow a stranger to coach you on how to keep a withdrawal or deposit below a supposed government threshold. The coaching itself may be evidence that the person is pushing you into a dangerous situation. The phrase suspicious activity also frightens people. Banks use monitoring systems to identify unusual behavior, but a flagged transaction is not the same as a conviction or a tax bill. A large transfer, new device, rapid series of payments, foreign transaction, or unusual cash activity may receive review. The purpose can include fraud prevention and compliance. Scammers exploit this by saying, "Your account was flagged by the Federal Reserve," or "The IRS has frozen your credit score." The Federal Reserve does not call ordinary consumers to resolve a personal bank fraud case by transferring money. The IRS does not control your credit score. Credit scores come from credit reporting models using information in credit files. The IRS can take lawful collection actions in appropriate cases, but a caller who says the IRS will erase or destroy your credit score within 1 hour is using financial vocabulary to create fear. People watching right now may have received a call mentioning the Treasury Department, Federal Reserve, Federal Deposit Insurance Corporation, Social Security Administration, Medicare, local police, or a bank fraud department. The use of several agencies does not make the story more legitimate. Criminals combine names because each name adds authority. They hope the victim will be too overwhelmed to ask which agency actually has legal responsibility for the issue. A real government process produces records, rights, and methods of review. A scam produces urgency, secrecy, and a payment destination. That difference is one of the clearest protections available. You also need to understand tax debt relief scams. A letter may say, "Final notice of federal tax lien, immediate settlement eligibility," or "You may qualify to reduce your IRS debt by 90%. Some mailers are advertisements from private companies, not IRS notices. The design may use red ink, official-looking seals, deadlines, or language copied from government forms. The small print may reveal that the sender is not affiliated with the IRS. Some private tax resolution companies provide legitimate services. Others charge thousands of dollars before determining whether the taxpayer qualifies for any relief. A salesperson may promise an offer in compromise as if it were guaranteed. But an offer in compromise is a real IRS program with eligibility rules. It is not automatic. You have to apply, disclose financial information, and meet the requirements. The IRS evaluates ability to pay, income, expenses, and asset equity. A company cannot guarantee approval merely because you received an advertisement. A retiree owing $18,000 may pay a tax relief company $4,500 after being told the debt can be settled for $500. Months later, the company may have done little more than request transcripts or submit paperwork the taxpayer could not support. Meanwhile, penalties and interest may continue, collection deadlines may matter, and the taxpayer may lose valuable time. The correct question is not, "Can this company make the IRS disappear?" The correct questions are, what exact service is being provided? What program are they recommending? Why do I qualify? What will the total fee be? What happens if the IRS rejects it? And who is the licensed professional responsible for my case? A salesperson is not automatically a tax attorney, certified public accountant, or enrolled agent. The FTC has taken action against operations accused of impersonating government agencies and using threatening tax debt messages. This shows how far the deception can go. A company may not merely advertise aggressively. It may create the impression that the communication came directly from the government. That is why the first task is to identify the sender. Read the envelope. Read the fine print. Search the company independently. Do not call only the number in the letter. Check your actual IRS online account. Compare the amount claimed with official records. If you truly owe tax, the answer may involve a payment plan, professional representation, an appeal, penalty relief, an offer in compromise, currently not collectible status, or another lawful option depending on the facts, but fear should not choose the option. Evidence should. This is also where retired people with 401ks and IRAs can be damaged twice. A scammer convinces them they owe the IRS and tells them to withdraw retirement money immediately. The victim loses the money to the scammer and may also create taxable income by taking the distribution. If the withdrawal is large, it can affect the year's tax picture, Medicare premium calculations in a later period, taxation of Social Security benefits, and the amount remaining for future income. Consider a 68-year-old married couple with $82,000 in combined pension, Social Security, and part-time income. They withdraw $60,000 from a traditional IRA to resolve a fake IRS emergency. The criminal takes the $60,000. The retirement distribution may still be reported on Form 1099-R and may still enter the couple's tax calculation. The victims are left with the theft and the tax consequences of accessing their own account. That is why no retirement distribution should be made during an unexpected telephone call. The legitimate IRS does not require you to remain on the line while you liquidate a mutual fund. A real bank fraud department does not direct you to transfer a 401k to a private wallet. A real financial advisor does not object when you request written information and time to review it. Rollover scams deserve special attention. A caller may claim that a former employer's 401k must be moved immediately because the plan is closing, the market is collapsing, or new federal rules will confiscate inactive accounts. The caller offers a special IRA, precious metal investment, cryptocurrency account, annuity, or private investment. The person may say the transfer is tax-free, government-approved, guaranteed, and available only for a few days. A direct rollover can be a legitimate way to move retirement money from one qualified account to another. But the existence of legitimate rollovers gives scammers a useful word. They call any movement a rollover even when the destination is not qualified. The investment is fraudulent, the fees are severe, or the transaction creates taxable income. When money moves directly from a qualified plan to another eligible retirement arrangement, the process is different from receiving the money personally and sending it somewhere later. A distribution paid to you may involve withholding and a 60-day rollover period under applicable rules. A Roth conversion may create taxable income on previously untaxed amounts. These are not details to accept from an unsolicited caller. They must be verified with the current plan administrator, receiving institution, and a qualified tax professional who is not being paid to sell the investment. A real rollover should have a traceable institution, written disclosures, understandable fees, clear ownership, and independent custodial records. If the destination account is controlled by the advisor, if checks are payable to an individual, if cryptocurrency must be purchased, or if the funds are going to an unfamiliar private company, stop. Retirement account scams often use the word safe. Safe from taxes, safe from inflation, safe from the market, safe from the IRS, safe from nursing home costs. No investment is made safe by the repeated use of the word. Safety has to be examined. What is guaranteed? Who guarantees it? What happens if the issuer fails? Is the principal liquid? What surrender charges exist? What tax consequences exist? Can the owner access the money for medical needs? Is the salesperson earning a commission? Inflation makes retirees vulnerable to promises because they can feel their buying power weakening. Groceries, insurance, utilities, property taxes, repairs, and medical expenses can rise while fixed income feels unchanged. A scammer presents a solution promising 12%, 18%, or even 25% with no risk. The person does not want greed. The person wants enough growth to avoid falling behind. But an investment promising high returns with no meaningful risk deserves extreme scrutiny. A fake IRS notice may even be used to make the investment appear necessary. The caller says retirement accounts are being reviewed under a new tax rule and must be moved into an approved asset. There is no universal IRS-approved secret investment for retirees. The IRS sets tax rules. It does not telephone individuals to select a private investment product. Required minimum distributions create another area of confusion. Owners of many traditional retirement accounts generally must begin required minimum distributions at the applicable age, which is currently 73 for many retirees. Roth IRAs have different lifetime distribution rules for the original owner. Inherited accounts can have different requirements, including a 10-year rule for many non-spouse beneficiaries, with exceptions and additional details. Criminals turn this complexity into a false emergency. A caller says you missed an RMD and must pay the penalty directly to him. An email says your inherited IRA will be seized unless you complete a withdrawal through a link. A fake advisor says the entire account must be liquidated before midnight. The real rules may create deadlines and tax consequences, but payment does not go to a random caller. The calculation should be checked against official records and professional guidance. The RMD amount is generally based on account value and an applicable life expectancy factor. It is not a number invented by someone who contacted you unexpectedly. A custodian may provide information, but the taxpayer remains responsible for meeting the rule. This is another example of this is not automatic. The existence of an automatic statement or reminder does not mean every tax responsibility is completed for you. But it also does not mean you must trust the first stranger who offers to fix it. Inheritance creates similar vulnerability. When someone dies, families are grieving, records are scattered, and money may be moving between accounts. Criminals search public records, obituaries, social media posts, and property information. They may contact a surviving spouse or adult child, claiming that the deceased owed taxes, had a secret debt, purchased an insurance product, or left unclaimed assets. The caller may say an inheritance tax must be paid before funds can be released. At the federal level, estate tax and income tax rules are not the same as a universal tax charged directly to every person who inherits property. Most ordinary families are not dealing with a federal estate above the very high federal filing threshold. Some states have separate estate or inheritance rules. Retirement accounts can create income tax consequences for beneficiaries. Property basis rules can matter. But a demand for an upfront wire to unlock an inheritance is a classic warning sign. For 2026, the federal estate tax basic exclusion amount is measured in millions of dollars, not a few thousand. That does not mean every inherited asset is tax-free in every situation. An inherited traditional IRA may carry income tax when distributions are taken. An estate may have income. A final return may be required. State law may apply. The lesson is not to assume there is never tax. The lesson is to reject the claim that an unsolicited caller can settle it through a same-day payment. A legitimate executor, attorney, court, tax professional, or financial institution should be able to provide documents that can be independently verified. The name of a real law firm can be copied, so search for the firm separately. Call a number obtained independently. Confirm the court case through official records. Do not rely on a seal, signature, or letterhead. If you want to continue receiving clear warnings like these, consider subscribing to the channel and turning on notifications so you do not miss the next information that may protect your retirement money. Now we must talk about Social Security and Medicare, because scammers rarely keep these systems separate. They know retirees see the IRS, Social Security, Medicare, banks, and the Treasury as parts of one large government structure. A scam may begin with one agency and shift to another without the victim noticing that the story no longer makes sense. A caller may say your Social Security number has been suspended. Social Security numbers are not suspended in the way the scam describes. The caller may say, benefits will stop unless you verify your bank account. He may say the IRS placed a hold on your Social Security because of an unpaid tax balance. Real levies and benefit offsets involve lawful procedures and notices. They do not begin with a demand for gift cards, cryptocurrency, or secrecy. Another call may say, Medicare is issuing a new card and needs your Medicare number. Your Medicare number should be protected like a credit card. Medicare may contact people in limited circumstances, especially when returning an initiated request or dealing with an existing matter, but an unexpected caller who requests information, money, or threatens to cancel benefits should be treated as suspicious. Hang up and contact Medicare through the official number. The fake Medicare call may be connected to tax identity theft. The caller offers a free brace, genetic test, pain cream, or upgraded card. He collects the Medicare number, date of birth, address, doctor's name, and other information. That data may be used for fraudulent billing, sold to other criminals, or combined with stolen tax information. The retiree may never see money leave a checking account, so he assumes no financial harm occurred. But fraudulent medical claims can create confusion in records, expose identity, and support a larger impersonation. A criminal database does not separate your tax identity from your medical identity. It collects everything useful. A fake Social Security caller may already know the monthly deposit amount because the victim disclosed bank statements in an earlier scam. He says, your $2,247 payment scheduled for the third Wednesday has been blocked. That specificity frightens the victim, but the information may have come from stolen mail, compromised email, a bank statement, or previous phishing. Never use private information provided by the caller as proof that the caller is legitimate. Ask yourself who else could have obtained it. Data breaches have exposed names, dates of birth, addresses, Social Security numbers, telephone numbers, and account history across the country. A criminal does not need access to a government system if the same information was stolen somewhere else. The most dangerous phrase in an impersonation scam is often, I am calling to protect you. Protection lowers resistance. The caller may say another employee is dishonest. He may give you a fake badge number. He may invite you to search his name online, knowing that he chose the name of a real official. He may warn you about common scams so that he appears trustworthy. He may even say, never give your password to anyone, and then ask you to enter it on a website he controls. This is the next level of deception. The scammer teaches you correct safety rules until he reaches the one exception that benefits him. He says, normally the IRS never asks for bank information by telephone, but this case is different because your refund was intercepted. Or, normally you should call the number on your bank card, but your card has been compromised, so that number will reach the criminals. Or, normally you should speak with family, but this is a sealed federal investigation. There is no emergency important enough to eliminate independent verification. If the account is truly at risk, ending the call and contacting the institution through a trusted channel is the correct response. If the caller says ending the call will cause immediate loss, that threat is evidence of manipulation. Let us return to the real CP53E notice because it contains the lesson that ties everything together. Federal payment policy has moved toward electronic payments, and the IRS generally phased out many paper refund checks after September 30th, 2025, subject to exceptions and implementation procedures. When a refund cannot be deposited, the taxpayer may receive official instructions. This creates a narrow period in which a person expects to discuss bank information with the IRS. Scammers target narrow periods of expectation. They send delivery scams after online shopping. They send bank scams after a large purchase. They send Medicare scams during enrollment periods. They send tax scams during filing season. They send inheritance scams after a death. They send refund scams when policy changes are in the news. Timing makes the message feel personal even when it was sent to thousands of people. The real CP53E notice generally provides time to respond through an official account. It does not require you to disclose bank information to a person who called unexpectedly. It does not require a release fee. It does not require a prepaid card. It does not require cryptocurrency. It does not require remote access to your computer. It does not require you to install an application so an agent can help. Remote access is especially dangerous. A caller may say he needs to guide you through the IRS website. He asks you to install software that allows him to see or control the screen. Once connected, he may view bank balances, tax records, saved passwords, emails, and personal documents. He may move the mouse, hide the screen, or alter what you see. A common trick involves making it appear that too much money was deposited into your account. The scammer changes what is displayed on the screen, or moves money between the victim's own accounts. He says the company accidentally refunded $20,000 instead of $200, and that the employee will lose his job unless the victim returns the difference. The victim sends real money to correct a deposit that never occurred. Never allow an unexpected caller to control your computer or phone. A bank, the IRS, Social Security, Medicare, Microsoft, Apple, or an antivirus company will not need remote control because of a surprise refund notice. If remote access has already been granted, disconnect the device from the internet, contact a trusted technical professional, secure financial accounts from a different safe device, and notify the bank immediately. Speed matters after a payment, but shame causes delay. Victims often wait because they hope the caller will return the money or because they are embarrassed to tell family. A scammer may promise that a failed transfer will be reversed after one additional fee. That is how the loss grows. The first $500 becomes $2,000. The $10,000 wire becomes a second $15,000 wire. The moment you suspect fraud, contact the bank or payment provider. Ask whether the transfer can be stopped, recalled, or frozen. Provide the receiving information, dates, amounts, and communication records. There is no guarantee of recovery, but delay reduces possibilities. Then secure accounts, report identity theft where appropriate, and preserve evidence. Do not delete the message before preserving useful information, but do not keep interacting with the criminal. Take screenshots. Record telephone numbers. Keep envelopes. Write down what happened while the details are fresh. Note the exact time, payment method, amount, receiving account, cryptocurrency wallet, ATM location, courier description, or gift card information. For suspicious IRS-related email or text messages, the IRS provides reporting channels, including phishingears.gov, mailtow.phishingeirs.gov. Suspicious texts can also be forwarded to 7726, which spells spam on many phones. IRS impersonation calls can be reported to the Treasury Inspector General for Tax Administration. Fraud can also be reported to the FTC. Reporting may not immediately return money, but it helps connect cases, identify patterns, and protect others. If tax information was stolen, review the official IRS identity theft guidance. If a fraudulent return may have been filed, Form 14039 may be relevant in certain circumstances. If Medicare information was taken, contact Medicare. If Social Security information was exposed, secure the online account and follow official Social Security guidance. If credit information was exposed, Consider freezes and alerts. One report does not automatically protect every system. This is not automatic. Many victims assume that notifying one bank alerts the IRS, Social Security, Medicare, credit bureaus, and every other institution. It usually does not. Each system may require its own action. That feels unfair when a victim is already overwhelmed, but understanding it prevents false security. Create a written recovery record. List each institution contacted, the date, representative, case number, and next step. Store copies of letters and reports. Criminals thrive in confusion. A simple record gives control back to the victim. Now we need to discuss dishonest tax preparers, because not every financial scam begins with a stranger pretending to be the IRS. Sometimes the person is sitting across the desk from you, preparing a real return with false numbers. The IRS warns about ghost preparers. A ghost preparer prepares a return but refuses to sign it or include a valid preparer tax identification number. The preparer may charge a fee based on the size of the refund, direct the refund into an account he controls, or invent deductions and credits. The taxpayer may be told, "Everyone does this," or "The IRS approved this method." But the taxpayer is legally responsible for the information on the return. The fact that a preparer typed the numbers does not erase the taxpayer's exposure. A false claim can lead to refund delays, repayment demands, penalties, audits, and enforcement. The preparer may disappear long before the notice arrives. Never sign a blank return. Never accept a return you were not allowed to review. Check the routing number and bank account number used for the refund. Confirm that the preparer signed the return and included the required identification. Ask for a complete copy. Compare income forms such as W-2s, 1099s, SSA 1099s, and 1099-Rs with the amounts reported. Retirees are particularly vulnerable to false withholding schemes. A promoter may claim that taxes secretly withheld from a pension, Social Security benefit, brokerage account, or retirement distribution can produce a huge refund. He may invent withholding on forms or misuse legitimate forms, such as 1099-R, 1099-DIV, 1099-B, or other documents. The refund appears on the return, but that does not mean it is legitimate. IRS systems compare amounts reported by taxpayers with information reported by employers, custodians, brokers, and other institutions. A fabricated withholding number may initially create the appearance of a refund, then trigger review when records do not match. A scammer may tell the taxpayer that the refund is legal because the software accepted the return. Tax software acceptance is not legal approval. Electronic acceptance generally means the return passed initial transmission checks. It does not mean every deduction, credit, income amount, or withholding entry has been examined and approved. The same problem appears with viral tax advice. A video may say every American can claim a secret self-employment credit, fuel credit, household employment refund, or capital gains credit. The presenter shows screenshots of large deposits and says the government does not want ordinary people to know. Most people never realize this. A real form can be used in a false claim. The form number may exist. The credit may exist. The eligibility may be narrow. A scammer only needs to remove the eligibility rules and present the form as free money. One of the 2026 warnings involves abusive claims connected to Form 2439, which relates to certain undistributed long-term capital gains. The form is real. That does not mean an ordinary retiree can invent an amount, attach a document connected to a famous company, and receive a lawful refund. Improper claims can lead to delayed refunds, audits, penalties, and other enforcement. This is why nobody is going to tell you about this must be treated carefully. Sometimes it introduces useful education. Sometimes it is the first sentence of a fraud. The test is evidence. Can the person show official eligibility rules? Can an independent licensed professional confirm the position? Is the promoter willing to sign the return? Does the promised refund depend on creating income, withholding, expenses, or credits that did not actually occur? A legitimate deduction reduces tax under a rule. It does not require a fictional transaction. A legitimate credit has qualifications. It is not created because a video says the IRS has a secret account in your name. There is no hidden treasury account that every citizen can access by filing unusual forms. A person may be tempted because the refund would pay off credit cards. Suppose a retired couple owes $14,000 at interest rates above 20%. A promoter promises a $32,000 tax refund for a $3,200 fee. The couple knows it sounds unusual, but the debt is painful. They sign. The refund is frozen. The fee is gone. The tax problem becomes worse. High credit card interest creates desperation, and desperation reduces skepticism. That is why financial protection cannot focus only on identifying fake logos. It must reduce the conditions that make an impossible promise feel necessary. A cash reserve, manageable debt, trusted professional relationships, and a plan for emergencies make a person harder to manipulate. Credit card companies, banks, and lenders also use fraud alerts that scammers imitate. A text may say, "Did you authorize a $986 purchase?" The victim replies no. A caller immediately follows, pretending to be from the bank. The caller already knows the victim will believe a fraudulent charge exists because the victim just responded. The caller asks for the card number, PIN, online banking password, or one-time code. The real bank alert may ask for confirmation through a secure system, but it will not need your full password. The safest approach is to ignore the number in the text and call the number printed on the card or use the official banking application. A criminal may also send a real payment request through a legitimate peer-to-peer service. The notification is genuinely generated by the payment platform, but the reason is false. A real security code, real app screen, or real bank notification does not prove the person requesting the transaction is legitimate. The system is real. The story is not. Here is another hidden risk. Scammers sometimes send a small amount of money to the victim and then claim it was a mistake. They ask the victim to return it to a different account. The original transfer may have come from a stolen account and could later be reversed. The victim's return payment may be separate and irreversible. Never solve an unexpected deposit by sending money according to a stranger's instructions. Contact the bank or platform directly. Checks create a similar trap. A fake check can appear in the account balance before the bank discovers that it is fraudulent. The scammer tells the victim to send part of the money elsewhere. Days or weeks later, the check is returned and the bank removes the funds. The victim owes the amount withdrawn or transferred. Availability is not the same as final settlement. Seeing money in an account does not always prove the payment is valid. This is especially important when selling vehicles, furniture, jewelry, or property online. A buyer sends too much, asks for a refund of the difference, and pressures the seller to act before the check is fully verified. Now we reach the most important revelation in this entire discussion. The greatest danger is not a single fake IRS letter. It is the financial chain that can begin after the letter, and the chain often looks legitimate at every individual step. The envelope looks legitimate. The QR code opens a professional page. The page collects information. A real verification code arrives from the bank. A real bank employee later sees a customer-authorized transfer. A real retirement custodian processes a customer-requested distribution. A real tax form reports the withdrawal. A real credit card payment fails because the account was emptied. Real systems carry out instructions produced by a false story. Visualize the machinery behind the scenes. A stolen social security number is entered into a database. Software compares it with an address and birth date from another source. A phishing page captures a bank login. An automated script tests the password. A one-time code is requested. The victim reads the code to a calm voice on the telephone. A new device is trusted. An external account is added. A small transfer is tested. Then a larger amount is scheduled. At another institution, the victim requests a retirement withdrawal because the caller says taxes must be paid. The custodian sells investments. The market sale becomes real. The distribution enters the bank. The bank sees available funds. The victim wires them to the supposed protection account. The criminal moves the money again. Later, Form 1099-R records the distribution. Months after the theft, the IRS sees taxable retirement income. The system did not understand the lie. It only processed the instructions. The bank knew a transfer occurred. The custodian knew a distribution occurred. The IRS knew income was reported. None of those systems heard the entire conversation that created the transaction. This is the invisible mechanism. Modern finance can verify credentials without verifying judgment. A password proves that the password was entered. A code proves that the code was received. A signature proves that a document was signed. None of those facts proves that the person was free from manipulation. Scammers exploit the gap between identity verification and informed consent. They do not always need to defeat the bank's security. They convince the customer to pass through security for them. They do not always need to hack the retirement account. They convince the owner to make the withdrawal. They do not always need to forge a tax return. They convince the taxpayer to sign a false one. That is why the most effective protection is a personal rule that fear cannot override. No unexpected caller gets money. No unexpected message gets a password. No urgent government notice is verified through its own contact information. No retirement account is moved without independent review. No family emergency payment is made without calling another known person. No one-time security code is read aloud to someone who called you. These rules may feel inconvenient once or twice. That inconvenience is a small price compared with the cost of rebuilding a financial life at 72. The protection should be physical as well as digital. Keep sensitive tax papers out of open mailboxes and visible trash. Shred documents containing Social Security numbers and account information. Retrieve mail promptly. Use direct deposit through verified channels. Review bank statements even when all bills are paid automatically. Look for small test transactions, new payees, address changes, and charges that repeat. Create alerts for withdrawals, transfers, card transactions, password changes, and new login devices. Use unique passwords. Turn on multi-factor authentication. Secure the email and telephone accounts. Establish an IRS online account before an emergency forces you to create one under pressure. Consider obtaining an IP PIN. Review credit reports. Freeze credit when appropriate. A trusted contact can add another layer. This does not mean giving someone unlimited access to your money. It means identifying a person you can call before making an unusual payment. Banks and investment firms may offer trusted contact options that allow them to reach someone if they suspect exploitation or cannot contact you depending on the institution and account. Choose the person carefully. Financial exploitation can also come from relatives, caregivers, neighbors, or professionals. A trusted contact should be trustworthy, financially responsible, and willing to respect boundaries. Powers of attorney and account access are legal tools with serious consequences and should be established with proper professional guidance. Do not leave a spouse completely uninformed about household finances. In many couples, one person handles everything. When that person becomes ill or dies, the survivor may not know where accounts are located, which bills are automatic, who the advisor is, or which notices are expected. That confusion creates vulnerability. Maintain a simple financial map. It should identify institutions, account types, insurance policies, regular income sources, important professionals, and where legal documents are stored. Do not place full passwords and account numbers in an unprotected document. The goal is continuity, not exposure. Discuss scams before they happen. Tell family members that no government agency will be offended by verification. Agree that an urgent request involving money will be discussed. Give older relatives permission to call without embarrassment. Never say, "How could you fall for that?" Shame is a weapon criminals use. A person who fears ridicule is less likely to ask for help. This helps both lower-income retirees and comfortable middle-class retirees. A household living on $2,400 a month needs protection because even a $600 loss can disrupt medication, food, and utilities. A household with $700,000 in retirement assets needs protection because criminals may spend weeks building a sophisticated operation around a larger target. The balance changes. The manipulation does not. When a real IRS notice arrives, slow down but do not ignore it. Identify the notice number. Compare it with the official description. Check the tax year and the issue. Review your IRS online account. Gather the return and supporting documents. Contact a qualified professional when needed. Respond by the legitimate deadline through the legitimate channel. When a fake notice arrives, preserve what is useful, report it, secure any exposed information, and warn the family. Do not let embarrassment create silence. Sharing one warning may prevent another person from losing a home repair fund, a pension distribution, or an inheritance. The educational information I have explained is general. It does not replace advice from a qualified financial professional, attorney, tax professional, accountant, or other licensed advisor who can review your exact circumstances. Tax rules, account agreements, state laws, and individual facts matter. But you do not need a professional degree to recognize the central warning. The IRS does not need secrecy to collect a legitimate tax debt. A bank does not need you to lie to its teller to protect your account. Social Security does not need gift cards to restore benefits. Medicare does not need your bank password to issue a card. The Federal Reserve does not need you to buy gold. A police department does not need Bitcoin to cancel a warrant. A legitimate grandchild does not need you to hide an emergency from every other family member. You have the right to pause. You have the right to hang up. You have the right to read a notice. You have the right to question an amount. You have the right to verify a person. You have the right to contact the institution independently. You have the right to refuse a payment method. You have the right to involve someone you trust. After decades of work, saving, paying taxes, raising families, surviving recessions, handling medical costs, and watching prices rise, your money deserves more than a rushed decision created by a stranger. The system is fast. Your protection must be deliberate. A real notice can wait long enough for verification. A real professional can provide written information. A real institution can be reached through an official channel. Only the scam collapses when you slow down. Remember the central rule. The notice may be real. The issue may be real. The refund may be real. The deduction may be real. The bank may truly have rejected a deposit. But the person offering to solve it may still be a criminal. This is why you must separate the information from the instruction. Verify the information independently. Then complete the instruction only inside the legitimate system. Nobody is going to tell you about every scam before it reaches you. The names will change. The notice numbers will change. The technology will improve. The criminals will use new tax laws, new payment policies, new Medicare cards, new Social Security adjustments, new bank alerts, and new artificial intelligence tools. But the underlying pressure will remain the same. Act now, keep it secret, trust this authority, and move your money. Once you recognize that pattern, the fear begins to lose its power. You do not need to become suspicious of every institution. You need to become disciplined about verification. You do not need to avoid online banking. You need to enter through trusted channels. You do not need to ignore IRS mail. You need to confirm it. You do not need to keep every dollar in cash. You need to understand that no legitimate government agent will send a courier to collect it. Financial awareness is not paranoia. It is maintenance. You lock your front door even though most people who pass your house are honest. You review a bank statement even though most transactions are correct. You verify an IRS notice even though many notices are legitimate. The habit protects you without controlling your life. Share this information with a spouse, parent, veteran, neighbor, coworker, or friend who may receive an official-looking message and feel pressured to act alone. A conversation held before the scam can protect years of savings after the scam arrives. And if you believe this warning is important, watch the next video appearing on the screen now. In it, I explain another silent financial trap that can affect Social Security, retirement withdrawals, and the bank accounts of millions of Americans before they realize what is happening.